Value investing, 15 points to look for when buying a common stock. From the book Common Stocks, Uncommon Profits by Philip Fisher. Reviewed and read by Sam Wadia, Certified Financial Planner and Chartered Financial Consultant in Singapore. Does the company have products or services with sufficient market potential to make possible a sizable increase in sales for at least several years? Question number 2. Does the management have a determination to continue to develop products or processes that will still further increase total sales potentials when the growth potentials of currently attractive product lines have largely been exploited? Here, examples like Google and Facebook come to mind. These highly innovative organizations have been developing as well as buying technologies that they see have value in the future, not just for consumers, but financially as well. How effective are the company's research and development efforts in relation to its size? We live in a technologically motivated and dependent era. So, research and development of companies as well as countries are becoming more and more important, and hence a good percentage of the company's profits ought to be channeled to research and development. Now, what is a good percentage could depend on the company as well as the industry it is operating in. Does the company have an above average sales organization? This is to say that the company is motivated and clear about its sales goals, its sales strategies, and constantly increasing its sales effectiveness. A company that comes to mind here is IBM. Does the company have a worthwhile profit margin? A good example of comparison between companies that are famous and in a similar industry but have quite different profit margins is Apple versus Amazon. Amazon famously has a very low profit margin percentage, whereas Apple functions at a very high percentage of profit margin. So it is quite clear that in this case, a company with higher profit margin is more advisable. What is the company doing to maintain or improve its profit margins? This is where I'm reminded of Warren Buffett's moat principle, which is to say that a company is positioned in such a way that its profit margin is not only protected through the course of years and perhaps even decades, but also keeps on improving. Of course, the margin cannot improve indefinitely unless it is a monopoly, and even then you can never go anything beyond 100%. We are talking about percentages. So the idea is at least maintain and be better than the competition. Does the company have outstanding labor and personnel relations? And the next slide is also related. Does the company have outstanding executive relations? This is to understand whether the company has a vast and diverse manpower working for its business, and what is the motivation and morale of that manpower, whether that's executive, personnel, or indeed labor working in perhaps factories or mines that are interested to continue working for the company and are motivated to give it not just their best but are also satisfied to stay on with the company. Does the company have depth to its management? So here we are talking about a certain amount of diversity in its management, and as contrast to a very sole-centric or perhaps CEO-centric organization where almost all the decisions are being made with the consent of only the CEO, and rather than a more democratic, a little bit less centralized organization where creative ideas get to flow up to the top, because we know that no one human being can be consistently correct all the time. How good are the company's cost analysis and accounting controls? Now, in today's day and age where reporting is very important, we often see that many organizations have quite good cost analysis because of modern technology, which includes enterprise resource planning software as well as accounting software. So the amount of manual calculations that goes into financial reporting has reduced quite a great deal since in the last 30-40 years. But controls are a totally different thing. Here we are talking about how conservative a company's financial accounting reporting is and financial management style is, such that costs are kept at a minimum, whereas the value that is added to the company's product line as well as consumers is maintained at a high level. Question number 11. Are there other aspects of the business somewhat peculiar to the industry involved which give the investor important clues as to how outstanding the company may be in relation to its competition? Now, this is a bit of a mouthful of a question, but the essence of it is, how good is the company in relation to its competition? Now, there are several metrics that can be used to understand the level of attractiveness of a company or competitiveness of a company with regards to its peers. And that includes the quality of the product, the price of the product, the costs associated with delivering the product, basically the cost of goods sold, as well as some of the other pointers we talked about previously, such as executive and personnel relations. So here one has to go a little bit deeper into the company's research and speak to not just the consumers of the company's products or services, but also some of the staff of the company as well as the company's competition. Does the company have a short or long range outlook in regard to profits? Now here I'm reminded of some Japanese companies that it seems have or used to have plans that were 100 or 150 years out into the future, versus several American companies that perhaps planned only 5 or 10 years down the line. This is something that the investor could understand by reading the letters by the senior management of the company, as well as perhaps having chats with the managers, the senior managers of the company, to check with them how far they are thinking. And this also ties in with whether they are continuously trying to innovate and develop and acquire products that will keep their profit margins as well as market share high enough, even if that means completely transforming the core business of the company, as did American Express, which happened to be an express delivery company, but that now is into finance. Question number 13. In the foreseeable future, will the growth of the company require sufficient equity financing so that the large number of shares then outstanding will largely cancel the existing stockholders' benefit from this anticipated growth? Now, again, this is quite a mouthful of a question. What this question is trying to say is, how well is the company funded? Does it need to sell more shares in order to raise capital, which means that the current shareholders' claim to the company's net assets would be then reduced. So suppose a company has 100,000 shares and it has to issue 100,000 more shares. Of course, there would be an incoming amount of capital that also offsets this dilution, but nevertheless there could be a dilution. So ideally we would like to invest in companies that don't just have to issue shares or raise capital by getting debt financing, but rather have enough money to actually pay off loans as well as buy back outstanding shares from the market, so that the current shareholders have an even greater claim on the business and producing assets of the firm. Does the management talk freely to investors about its affairs when things are going well, but clam up when troubles and disappointments occur? Again, a bit of a mouthful of a question, but the idea is that does the management remain open in its communication with investors at all times about the affairs of the company, the essential information that it should be giving out to investors about possible opportunities as well as threats that the company does face. This again goes back to the management and its values, its ethics, right to the very top, and it is linked to the next question: does the management have unquestionable integrity? This is a very important, perhaps the most important aspect of the management of the company before one chooses to buy into a firm, is whether the managers are truly working in the interests of the shareholders, ideally by being shareholders themselves, or are they simply wanting to enrich themselves through scrupulous as well as unscrupulous means. Which is to say that even though there could be a conflict of interest between the managers and the owners, which are the shareholders of the company, the managers have the ethics and integrity to act in a way that is worthy of their position in the company. So this covers the last of the 15 questions that one must ask before investing. Closing thoughts. Research the company well before you make any decisions. Weigh your decision in the grand scheme of things, considering how much money you have to invest, when do you need it back, what is your risk profile, etc. And finally, when both the research and the weighing has been done with diligence, one can move with strength and act to make the purchase. Hope you have learnt a few things. Thank you very much.